Bloomberg Tech is live from coast to coast with Caroline Hyde in New York and Ed Ludlow in San Francisco.
This is Bloomberg Tech. Coming up, SoftBank sells its entire stake in Nvidia for close to $6 billion. This to help bankroll its other AI investments.
Plus, we sit down with CoreWeave CEO Michael Intrator to talk about the company's earnings and that data center delay.
And more earnings with Paramount Skydance as the company reports its first results since David Ellison's takeover.
Much to digest when it comes to the fundamentals of businesses today, Ed. But overall, we've got a bit of risk aversion here. We've got some of the biggest players in technology on the downside. You're going to drill into the individual movers. But there is a question of AI infrastructure. There's a question of pressure on some of these market capitalizations. We're just off 0.8% after yesterday's bounce back on hopes that the government shutdown might be reaching some sort of end. But Ed, take us to the individual movers.
Yeah, CoreWeave is where we start. The stock down about 13%, on track for its biggest drop since mid-August. The stock trading at its lowest level since early September. In a few minutes' time, we're going to speak to the CEO, Michael Intrator. The company cut its revenue outlook for fiscal 25, or trimmed it really, because of a delay to a specific project. The other thing that's weighing on the markets right now is Nvidia. Nvidia down around 2 percentage points when last I checked. The issue is right now, 3% now, that SoftBank sold its remaining stake in Nvidia in its entirety. It's not unprecedented. SoftBank has sold out of Nvidia before. I'd also remind our audience, yesterday Nvidia jumped almost 6%, on track for its biggest jump, or was its biggest jump since April. But the market's a little nervous here. There's a lot to unpack, Caro.
There is, and let's unpack it with our executive global tech editor, Peter Ellison. Peter, talk us through what is happening, because as Ed says, this is not unheard of, and in many ways, what they use the money for could end up being a benefit to Nvidia longer term.
Yeah, that's exactly right, Caroline. So SoftBank reported earnings for the quarter. They were really blowout earnings. They reported about $16 billion in net income. That's roughly 6 times what had been expected. A lot of that came from some of their investments in AI, including their stake in OpenAI in particular. But as you mentioned, they decided that they were going to sell their entire stake in Nvidia and take the $6 billion so that they could make other investments with it. Now, a big part of where they're going to put that money is into their Stargate venture, where they're building these AI data centers in the U.S., and they're going to buy Nvidia chips to put into those data centers. So partly Masayoshi Son is getting this cash so it can make investments in AI. Some people may be reading it as a negative sign for AI and for Nvidia in particular, but in fact, he's going to use that money to make investments.
Again, not unprecedented. Nvidia was a stock that SoftBank sold out of in 2019. And then in 2020, they started building up a stake again. And some of those paper gains have been to SoftBank's benefit. The issue is that management faced a lot of questions, both about what they're doing here, their rationale, what they're going to use the cash for, but also, are we in an AI bubble, Peter? What did they say?
Yeah, that was one of the questions that came up. So Masayoshi Son doesn't do the earnings calls anymore. He stopped doing those a few years ago when he was taking ARM public. But he has said a number of times that he regrets selling Nvidia shares in 2019, as you referred to. Those shares would have been worth more than $200 billion now, which is more than the market cap for SoftBank at this point. But so the person who subs in for him is the CFO, Yoshimitsu Goto, and he talked through these issues. He did get some questions about the Nvidia shares. He said it's not that they don't believe in Nvidia anymore. He also got the question you're referring to, are we in an AI bubble? And he said it's hard to tell at this point. Not quite the same kind of conviction you would hear from Sam Altman or from Jensen Huang, but he's realistic about we're not really sure where we are in this cycle. But to be clear, Masayoshi Son is going to keep making investments.
Peter Ellison breaking it down. We thank you so much. Let's talk about where we are in this cycle, because CoreWeave shares, as Ed pointed out earlier, under pressure. That's after it lowered its annual revenue forecast due to a delay at a third party developing a data center. It really overshadowed impressive growth in revenue and order backlog. Let's get straight to it with CoreWeave CEO Michael Intrator. How frustrating is it that you don't own your entire supply chain? How much of an issue is the sort of power you have to give to third parties?
Oh, so look, I think it's important to understand that every single part of this ecosystem is dependent upon other parts of the ecosystem. Nobody controls the entire supply chain. And that's just the nature of doing business at this scale on projects that are as complicated as this, whether it's design and architecture of the chips, through the fabrication of the chips, through the building of the data center, through the concrete that has to go into the data center.
Yes.
Like, it's just, it's really hard to even contemplate a world in which you have true control over every aspect of it. And so you're going to work with partners, and you're going to work with good partners that are able to help you drive your business forward.
Is this a good partner who's had issues at this PowerShell level?
Yeah, look, they are a good partner, right? Like, we've been working with these guys since 2018. There has been a stumble, there's an issue. The issue is going to be cleaned up rapidly. But I wouldn't say that they're not a good partner. I think that, we've gone back and contracted with them again and again, and they've contracted with us again and again because, we do work well together. It's just, occasionally you hit a bump in the road. What we're talking about here is a contract that gets pushed back by 1 quarter, let's say, and that the impact of that on our revenue is a delay of revenue, not a loss of revenue. And I think that is the definition of working with an ecosystem of good partners.
Michael, good morning. Which customer was it, please, that was impacted by this delay?
We don't speak to specific customers within the data centers. That's not how we look at it. But we really are working with the whole or a material part of the broader kind of ecosystem that consumes compute at this scale. So that's this is a large project. It's from a large counterpart. And like I said, they understand the impact of this delay, and that they are shifting with us the contract back to ensure that the total contract value that was being contemplated is going to be captured at this facility.
I thought you might say that, but I wanted to offer you the opportunity to explain who the customer was anyway.
I appreciate that.
This is going to sound a little bit like I work in your internal audit team or in your risk team. But there is a bigger issue here of managing third-party risk as much as you can. So if your supply is tight today, what procedures are you putting in place for the event that your backlog doubles and supply is even tighter down the road?
Listen, that is the question that we work on across our company continuously, right? And if you think about the messages that I was trying to communicate during the earnings call yesterday, I talked about the incredible impact of the effort that we've had to diversify our clients. We started the year with 85% of our revenue to a single client, and we are coming out of the year with our backlog with which has reached all-time highs, where no specific client is more than 35% of it, and that is down from 50% even last quarter. So you're seeing tremendous progress on the contracting side. On the supply side, when you're looking at the powered shells, the data center providers, there is no single provider of data centers that represents in excess of 20% of our 2.9 gigawatts of power that we will be delivering to the market over the next 24 months. So you're seeing a real focus by our company to diversify on both sides of the the ledger. The clients that we are delivering infrastructure to, as well as the suppliers that are delivering us the components that we need to be successful.
What can be done? Because we hear about power issues. We hear about how much people maybe need government to help speed up contracts, supply chain headaches. What is it in this particular data center issue that won't be replicated down the road? How are you making sure, or is it just something we are going to see time and time again, do you think?
Look, the way that we are handling this is we are doing several discrete things to ensure that we are future-proofing ourselves against these type of delays, right? So we have our team that has been built out over the past year that builds and delivers data center. And so we have a self-build organization to be able to deliver our own data centers. For instance, Kenilworth in New Jersey, or Lancaster in Pennsylvania, where we are building from the ground up. Those skill sets, being able to deploy those individuals with those talents down to the data centers as they're being constructed by third parties, if they encounter problems where we can be useful, helpful, thinking through ways of solving and driving the process forward, is really important to being able to mitigate these type of delays. We have massively diversified our data center providers, so we're not exposed to any specific data center provider in too large of a component. And then the third piece of it is it's important to understand that as we get larger, as our delivered power gets larger, the relative impact of a delay at any one given site becomes less and less meaningful and less impactful on our run rate. And that's really important. Like you're encountering scaling issues within a company that's encountering scaling issues within a supply chain. Both of those will get better. Time solves that, scale solves that.
We are currently seeing that time isn't particularly helping the share price as we speak. It's now down 14.3%, worst day since August. We are here with Michael Intrator across radio and TV. And I want to sort of ask whether you think more broadly the US is stunted by the supply chain headache, or do you think there is something that can be done from a federal perspective here to ensure that you can build at the rate you want to build? You're not having these sorts of headaches.
So we've been, we and many others have been, quite forceful in making the case that there is a role for government in helping us with some of the permitting issues, speed to which we can get our infrastructure and others can get their infrastructure attached to the grid, all of those type of things where there's a great role for the government to help in that. They are the organization or government entity that is correctly positioned to help facilitate that. And I think that's a great role where government can lean in and make an impact across the space broadly.
Michael, you have an agreement with Nvidia that lots of people find very interesting, that down the road, if there is spare capacity, there's some flexibility for you to deploy it elsewhere. That's a simple summation of it. But I'm wondering how you're thinking about serving some of the smaller AI labs and casting that net even wider in your customer base, if indeed that capacity gets freed up down the line.
Yeah, it's a contract I'm actually incredibly excited about, right? It's a contract that we did with Nvidia, where we will deliver them compute for the next 6 years. But in the contract is the capacity to interrupt the flow of compute to them, and that will allow us to repurpose that compute to new companies, startups, companies that have struggled to get access to the compute that they require to bring new companies, organizations, ideas into existence. And I think it's just an incredibly important component of how the infrastructure is so important to allowing the ecosystem itself of these startups, of these new companies, of these new ideas to become more resilient, to become more scaled. And it's just a great contract for us to be able to position ourselves. It also provides this wonderful on-ramp for us to be able to work with the new amazing companies that are coming into existence, right, so that they integrate into our solution and get to make use of the best alternative that exists in the market as they're scaling their companies.
Michael, to finish, to what extent is Nvidia still the gold standard, Nvidia's GPUs for your customer base? And what data are you tracking on demand for those kind of more inference-specific chips that are offered by others?
Yeah, so look, we have always been client-led, right? Our clients come to market and tell us, hey, we would like you guys to help us build a cluster. We need it to be this size and this location and this type of network. And we work with them in a very kind of interactive way to ensure that the infrastructure that we're building is the best infrastructure for them, is fungible for us, like all of these type of requirements to make for successful delivery of infrastructure. Right now, the reality of the situation is the buy signals from our clients overwhelm our capacity to deliver infrastructure to the market. Matter of fact, they overwhelm the entire market's capacity to deliver infrastructure to the market. You have a systemic shortage of ability to deliver the GPUs, the computing infrastructure for the build out of artificial intelligence. And we have never wavered from that position. We have been very, very clear that, when we look at the demand signals coming into CoreWeave, the totality of that overwhelms the capacity of the market to deliver that, and will continue to do that for quite a while.
Michael Intrator, CoreWeave CEO, thank you for coming back on Bloomberg Tech. Okay, I'm also taking a look at shares of Nebius. This is the neocloud spun out of Russia's Yandex a year ago. The US listed shares down more than 3%, but in the quarter saw growth of 300% year on year and has added a major contract with Meta that's positive upside. Maybe this was a high bar kind of quarter where the market saw it coming in. But, Kara, I think you'd agree Nebius is a name that's coming up more often in the context of hyperscalers and, in this case, Meta, using them for off-ramped compute.
All about the supply of AI infrastructure. But coming up, we steer towards earnings again. Paramount Skydance raising its target, though, for job cuts and for cost-saving measures. We'll dig in next. This is Bloomberg Tech.
Back to earnings with Paramount Skydance, which reported its financial results for the first time since a new investor group took over in August. The company raised its target for job cuts and cost-saving measures and is forecasting $30 billion in revenue next year. Let's break it all down with Laura Martin, Senior Entertainment Analyst at Needham. I don't know, hello, what's being cheered here? Sometimes cutting your way to profit and cutting your way into a good financial position is not the most exciting story. What is the Laura Martin main takeaway?
Well, the Laura Martin main takeaway was I thought they left more questions unanswered than they answered. So I think one of the big questions is they just did an affiliated transaction with Oracle, which for enterprise software, which is the dad's company. So now you can, through pricing, move money between these two public companies. That sort of was weird. And then also they said they're going to spend $1.5 billion on content and double their film slate from 7 films a year to 15 films a year starting in 2026. And the problem with that is the Skydance track record is 1 theatrical release a year. So going to 15 means not only are you spending the money on the negative cost, but now you're going to spend about $100 million each marketing, which all just sounds like an awful lot of money that you're spending in the near term, which is a tax on public shareholders before you get the return. It takes about 3 years to release a movie between greenlighting and a release, which means you have a couple investment years ahead of you, which doesn't sound like, so we're going to stay on the sidelines here in terms of the shares.
I want to go back to that relationship between Oracle and the affiliated transaction that you mentioned, implying that the value can be transferred between the two public companies. How much is that a help if you're thinking about the sheer scale of money David Ellison needs, perhaps from Larry Ellison to keep on buying in WBD assets? Or how much is it a concern just in what are you actually buying, an entertainment company here or a tech and AI infrastructure bet?
So I think that is one of the differentiated things they're saying that our content storytelling is complementary to our tech stack, and our tech stack needs investment because Paramount, the old Paramount, sort of starved it. So we P-Sky are going to invest in the tech stack. So from a fundamental point of view, they're going to try to marry storytelling with Gen AI tech, which is sort of a cool messaging, although expensive in the near term. I would say the Oracle point was just a new piece of information we got, having nothing to do with Warner Brothers. Like if the dad writes a $70 billion check to Warner Brothers, that's a bigger deal than a contract might be several million a year. So it's just an affiliated transaction that I just would really like to see the pricing on when they have to disclose it in a 10K. But it's just a new piece of information. I think the big issue is you don't know what you're buying here. Are you buying a $16 billion subscale Paramount Skydance, or are you buying are they going to use money to make a $70 billion acquisition of all of Warner Brothers? And then that's round numbers, $100 billion scaled player with bigger everything, including studios. So then you wouldn't have to double the films because Warner Brothers got 15 by itself already. So I think they might be justifying of Warner Brothers' bid in some ways with some of their cost estimates here.
Laura, very quick pivot here. You just heard the CoreWeave interview. You published your research on hyperscaler capex. Just a quick reaction to what you heard?
Yeah, so I mean, I think one of the biggest question we get is, are the hyperscalers spending too much money on infrastructure? And we published a note this morning showing that the Gen AI implementations at Amazon, Meta, and Alphabet are accelerating their revenue growth and cutting their operating costs. So they're getting margin expansion by using generative AI tools, which gives them the confidence to invest in these infrastructure plays to then sell to third parties those same capabilities to lower costs and drive, faster product innovation for the rest of the U.S. economy. So I actually think that the biggest funders of generative AI infrastructure are seeing the biggest benefits already in their own businesses.
Laura Martin, on optimistic note for the end. We really appreciate it always from Needham. Keep coming back. Thank you. Coming up, key AI departures over at Intel and Meta. We're going to be digging into why next. This is Bloomberg Tech.
The valuations don't look crazy, but they do if there's nervousness on the growth story. And that's why I think the AI story, of which we do remain bullish, and we do think that there is a lot further to go, it is likely to be a volatile ride.
That was BlackRock's Helen Jewell discussing the nervousness we're seeing in AI stocks right now. You can see that in Nvidia, and you can see it in CoreWeave, as we've been discussing all morning. The risks aren't only about lack of growth. Bloomberg opinion columnist Chris Bryant writing about that. There's a quote, a danger of depreciation tsunami linked to the short lifespan of AI chips. His piece focuses on AI investors ignoring warnings from short seller Michael Berry. You can check that out on the Bloomberg Terminal or .com. Karen.
Yeah, now, though, Ed, it's time for Talking Tech. And first up, Microsoft is planning to build a $10 billion AI data center along the Portuguese coast. It's working with Start Campus, a Portuguese developer, and British startup Nscale, one of Microsoft's biggest European investments this year. Plus, Intel's Chief Technology and AI Officer, Sachin Katti, has left to join OpenAI, where he'll be working on the startup's infrastructure efforts. Back at Intel, CEO Lip-Bu Tan will take over Katti's role. And reports on another major departure, Meta, is set to lose its chief AI scientist, Jan LeCun, according to Financial Times. LeCun is reportedly leaving to launch his own startup, focusing on what he calls world models, and is in early talks with investors to raise funds. Ed.
It's halftime. We'll be right back. This is Bloomberg Tech. Welcome back to Bloomberg Tech. If you're just joining us, our top stories are CoreWeave and Nvidia. Nvidia down 3%. SoftBank is selling out of the entirety of its almost $6 billion stake in the company because it needs cash to finance its other AI ventures. The street not really seeing this as a concern about Nvidia itself, but in aggregate, taken with CoreWeave's almost 14% drop, there are some jitters in the market. CoreWeave is down after just slightly trimming its outlook for sales in 2025 because of a delay on a specific data center project, that delay attributable to a third party. And in an interview with the CEO earlier in the program, we didn't really get any answers on who the customer impacted is. But with time and with scale, such supply issues will go away. The market right now not buying it, Kara.
They're not. And let's stick in with the fact the market's not buying it. Bloomberg Equities reporter Carmen Reinicke is here with us. And it's interesting. The jitters around AI of late have been around an AI bubble and demand concern. But ultimately, these are supply-side issues, constraints for CoreWeave, maybe cash constraints for SoftBank and needing to sell off Nvidia.
Yeah, it's really interesting how this has shifted really from the dip buying that we saw yesterday that drove Nvidia up. CoreWeave, I think, was also up before the bell, before it reported its results. And now we're seeing really any concern on either side, AI bubble or supply here, is really weighing on these shares. I think as the AI theme just continues to get stretched, investors are nervous and they're really ready to sell at kind of any moment. This especially coming before Nvidia results next week. Obviously, the whole market really looks ahead to that, but shares going down into Nvidia results is a little bit different than what we usually see.
Right. Carmen, you made a really good point, and I'm going to bring up a chart to illustrate it. Yesterday, Nvidia jumped almost 6%, which was its biggest jump since early April. So a drop-off of 3% or more in the session, taken into account with the news flow, give that context. Generally speaking, though, what is the sentiment of the investors that we're speaking to right now? Are they still like mega bullish on this long-term trend that they think will just carry on and keep going?
Yeah, that's a really great question. I think people are very split, but I hear a lot of people that are still very bullish on the long-term trend and even say that some selling now or a little shakeout in the market would be pretty healthy. I mean, valuations are very stretched. We're 3 years into a bull run. These are some of the biggest stocks in the overall market, so it makes sense that they drag down the entire index. So a little bit of a shakeout here wouldn't be a huge concern. Obviously, this is really overlaid, though, with the fact that people are really talking about an AI bubble. And so I think any selling in any of these stocks, even, at the end of the year when people are sort of looking to lock in performance, lock in gains, it, sparks more conversation around this entire debate about an AI bubble.
Bloomberg's Carmen Reinecke, thank you very much. Meanwhile, shares of Nokia and Ericsson closed higher in European trading. Sources say the European Commission is weighing steps to push EU members to phase out Huawei and ZTE gear from telecom networks amid security concerns. For more, let's get out to Bloomberg's Dillian Deutsch, who joins us with the reporting. This is timely and this is very interesting. What do we learn in the course of reporting about how serious this move is to push Huawei out of a market that it is very strong in Europe?
Yeah, I think it's actually really important to note people do not realize that there's still so much Huawei kit in various EU countries' infrastructures. And the European Commission for years has wanted to push EU countries to stop using this technology across their networks. They have really failed to do so. And the new commission that came in 2 years ago, they're doing a new push. They're going to try to get different EU countries to force out Huawei and ZTE. Now, I cannot overstate how difficult this is going to be. Like I said, the previous commission tried to do this and they did not have the political backing. Things like critical infrastructure, things like national security, these are left up to the member states of the EU. So essentially what has to happen is these countries all have to come together and say, yes, actually, we're going to hand over that power to Brussels, to the European Commission to make that a reality. That is a tough pill for a lot of countries to swallow.
Countries such as in your piece you make clear, Spain, Greece, which have remained relatively dependent. Interestingly, UK, we know that they've been pulling away for a long time, banned any Huawei infrastructure, similar with Sweden. So it can be done. It's interesting that China sort of tried to point out that it slowed those nations down, though.
Yeah, it's a great point, Caroline, because, a lot of the operators and independent analysis has been done to show that actually by forcing a strip out of Huawei from the UK networks, that delayed 5G roll by up to 2 years. This is a very costly ambition from certain countries if they want to go ahead with this kind of push. Not only does it delay possible technology development, it also comes at great cost to the operators. So if you look at Germany, for example, some people in the government are examining ways that, if they were to try to force Huawei and ZTE out of their networks, could they compensate operators? That obviously would soften the blow for a lot of these operators, but this would come at a great cost then to governments, if not operators.
Dillian Deutsch, it's a great read. We urge people to go take a read of it. Thank you very much indeed. Let's take a look at crypto more broadly right now, because we want to pivot into the world of Bitcoin. It's too seeing some risk aversion selling today. We're off by 2%, 103,000. Remember, it remains below its moving average target. So 100-day moving average, for example, at 110,000. It remains trading below that. People fearful they won't be seeing any sort of breakout. We're seeing Gemini space station, though. Gemini, of course, crypto exchange, went public recently, off by 15%. That's after its earnings just showed that, perhaps they're not managing to ramp into any sort of profitability as soon as people had maybe hoped. Let's bring in Bloomberg senior crypto reporter Olga Karaf, who can dig into the Gemini story, because they were a beneficiary of the changes in regulation in the United States. But why did it underwhelm on the quarter just reporting?
So, like you said, the Winklevoss twins that founded Gemini, they have been very strong supporters of President Trump. And a lot of crypto companies went public this year. As we've seen sort of deregulation and more favorable regulatory environment towards the industry. But the fact of the matter is that the company, Gemini, is unprofitable. And some analysts basically don't expect it to become profitable until 2 or 3 years from now. And what we've seen this quarter is that the losses widened partially because of this IPO-related expenses and marketing expenses. But people are wondering, sort of, what about profitability? When is that going to come?
Olga, it's good to see you. Dan Chen, the CFO, talked about the expenses issue and it being strategic. For those that have never come across Gemini, what's the business model on paper? Just explain the basics of how it's supposed to function, because then that will make the loss probably more digestible.
Sure. So it's a crypto exchange. So their biggest rival is Coinbase here in the U.S. And essentially, they make their money, about half of the money, off of trading fees as people trade Bitcoin, Ether, and other cryptocurrencies. And then they also have other businesses, such as their credit cards have actually been on a roll, and they've been able to grab a lot of new users through credit cards that essentially allow you to earn crypto rewards as you spend money. They also have a custody business and some other businesses.
Bloomberg's Olga Kharif, thank you very much. Now, coming up on the program, Alibaba's Singles Day is underway, and this year, AI isn't an option for shoppers. We're going to have more on that next. This is Bloomberg Tech.
China's Singles Day, it is underway, now in its 17th year. But shifting consumer habits and a fierce price war, they've turned the one-day shopping blitz into a weeks-long campaign. Bloomberg TV's chief North Asia correspondent, Stephen Engel, really examines China's evolving consumption trends amid a tougher economy.
Influencer peddling is all the rage in China. Online, of course, but now more than ever before, on the actual trade fair floor as well, where rapid-fire hawking of product over multiple mobile phones direct to China's billion-plus consumers has never been this, well, in your face.
I don't know how they talk so much. Everything you would possibly need to know about Vietnamese iced tea.
And other products from overseas. Doesn't matter if it's New Zealand milk powder and ice cream or Italian cleaning supplies, complete with a Mandarin-speaking European. They're all competing for Chinese cyber shoppers in a market where around 40% of all retail sales are now done online.
A single day, 11/11 is huge. We have a strong presence on online platform, and we have a strong focus on Gen Z.
I know Singles Day had another few more weeks to go, but so far the result has been very, very encouraging.
Online shopping in China is growing at 3 times the pace of traditional retail, with many brick-and-mortar outlets feeling that pain. CPI did pick up slightly in October, but overall retail spending is expected to have slowed again as households hold on to savings amid economic uncertainty. Add to that are lingering worries importers and exporters here feel about the fragile trade truce with the United States.
High tariffs are hurting everybody, hurting both sides. One of the things that as businesses we do hope is that there is longer than a 14-month detente, shall we say, but that there is some general baseline of the relationship. These are areas we're going to trade in. These are areas that are no-go. This is kind of a gray area where we'll keep negotiating on, because that would help us all, to your point, really understand what we can move forward. And if I do want to have a 5-year contract with an American supplier, I know no matter what, I'm going to get that product.
I think it's been critically important that we have clarity.
U.S. wine exports to China this year were down 77% in the 7 months through July from a year ago, with Chinese tariffs and taxes combined amounting to about 75% on American wine. And yet Barros is cautiously optimistic for a recovery, as the truce has kept tariffs from escalating further.
It was a very, very positive development that they came up with an actual number that's going to be in place for the next 14 months. Because before that, I think a lot of importers weren't so upset about the tariff. They didn't know what it was going to be. And so now we know what it's going to be, at least through the end of December of 2026. And I'm hoping that that brings some normalcy back into the process.
It's an endurance game shared in some respect by the many influencers in nearby booths, to keep talking and to keep the parties on the other end engaged. Stephen Engel, Bloomberg News, Shanghai.
We stay with Singles Day. This year, for Alibaba, artificial intelligence takes center stage as the company pushes out AI-driven search results. Deborah Weinswig, Coresight Research CEO, says, quote, winners going forward are brands investing in AI-driven personalization. The retail playbook now blends tech, trust, and instant gratification commerce. Deborah Weinswig joins us now. Deborah, that report from Stephen out of mainland China, fascinating, learning about sort of the scale of the event. But we'll zero in on Alibaba and where AI is or isn't making the difference. What's your assessment about where they stand in that market, which you just outlined is pretty chaotic at the moment?
Well, first, thanks for having me on. Second, as we look at Alibaba specifically, I would say that last year they were dipping their toe in the water, and this year they're in kind of up to their thigh as it relates to AI and the shopping experience. So starting at the very beginning, all the way through their kind of the PDPs or the information behind all of the images on the website to what you've bought previously, so that they serve up products you are more likely to purchase. But it's all AI driven, and it's highly personalized in a very short period of time, so that return rates are dropping, which is a positive because you're buying more of what you want. And it's also much easier to do the research you need and that you want to do in order to find the perfect gift for others or for yourself.
Deborah, we actually had some headlines out of China crossed since we came on air. Xiaomi's single day sales exceed 29 billion yuan, which, if my math's correct, is just slightly above $4 billion US. That's Xiaomi. What do you make of that number, and put Xiaomi's success in Singles Day into context of what you just told us about Alibaba?
Yeah, we've continued to hear from a lot of Western brands that their sales are exceeding expectations. And I think what they're learning from that is to think about how to bring some of those learnings back to the US. But this idea that the consumer can find and buy. And when you think about like Xiaomi, right, this idea that the consumer, and this was actually one of the probably key areas of interest, is that they call them like AI toys, but like AI toys have been one of the hottest categories, that and beauty. And so the Xiaomi numbers, I would say, probably are a little higher than we would have expected, but that's the trend that we're seeing, and we believe that'll continue to strengthen.
Xiaomi makes AI toys on wheels, cars, but also ones that you have in your hand. How much are you seeing at the moment the luxury perspective, though? Because Xiaomi's been hot on the heels of a Tesla, and everyone's thinking about the amount of market share that these local domestic players are now taking in the world of EV and, of course, phones, but relatively luxurious products to be spending on. Where do you see just general consumer appetite right now?
That's a great question, and we've done a lot of research on this. So what we're starting to see is I would say, a strengthening at the high end. But when it comes to, let's say, basic essentials, going back to this idea of research and how much easier it is to find product, consumers are, I would say, being increasingly frugal on everyday necessities and then looking to treat themselves. So I would say AI is helping them get smarter, but we are, I'd say, probably earlier than many people expected. We are starting to see a strengthening in the high end.
What are they buying in terms of AI wearables? And they're like, I'm seeing Oura Ring and Oura Ring. There's lots of new competitors on the market here in the United States, but I can only imagine the raft of options you got to purchase over in China right now.
I mean, we're seeing really interesting things on the wearable side, like bracelets and pins and whatnot. Other kind of like even health sensing, body sensing. Can you find your mate depending on the your kind of the electromagnetic field that you're like? It's really, really interesting in terms of how it really is their toys to make your life more fun, but also better. And I think going back to this idea around data from a healthcare perspective, that's increasingly important, and we're seeing it drive improved results for consumers as well.
The data sets that you're tracking, even from this year's event and prior years, if you've got any assessment of like the investment these companies have to make to get a payoff, like how committed they are to winning, what you've outlined very clearly is a bit of a scramble to get consumers who are making very conscious, proactive spending choices.
So therein lies that is like the question of the day, and one of the biggest differences between the Western consumer and the Chinese consumer is, this isn't like, you're clipping coupons. Well, I guess you're clipping them, but digital. And as we're seeing it go into the end of the Double 11 shopping season, how the couponing, right, it goes back to it's adjusting in real time. So if retailers and brands aren't seeing the desired outcomes, they're able to change it in real time, right? These aren't like marketing plans built out 6, 12, 18 weeks ahead of time. And therein is why I think we're going to see a much stronger Double 11 season than we have in the past. And those retailers, like Lululemon, is in the minds of the Chinese consumer. That's a local brand because they've really embraced this. And they did have to invest, of course, early on, but now they're reaping the rewards of that investment. And so that's like Lululemon, L'Oreal, those are some just great examples of brands, right? So European brand, a US brand, or Canadian brand technically, North American brand, of companies who have invested, and as a result, they're seeing outsized rewards.
Instant gratification commerce is the line on your note. We really appreciate it. Thank you, Deborah Weinswig, for joining us. Coresight Research. Coming up, Oracle co-founder Larry Ellison gets more employees under his supervision after the company's CEO swap. We'll discuss what that entails next. This is Bloomberg Tech. % of Oracle's workforce now report to Chairman and Chief Technology Officer Larry Ellison. The move came after the company changed CEOs in September. Bloomberg's Brody Ford, who covers Oracle for more, joins us. Safra Katz moves on. There's co-CEOs. Yet, last time I checked, 81-year-old Larry Ellison is in control and has reports of 40% of the workforce?
When you hear about an executive transition, you think about words like succession. You think these new CEOs are going to control the company. That's what a CEO does. So, yeah, we found it pretty interesting, and the readers have as well, that Larry Ellison himself, the kind of tech industry legend, directly controls a huge swath of the company, including development of its kind of most crucial applications.
Okay, let's look at this another way. What are the names of the two CEOs leading the company, and what is it that they are responsible for, and who reports to them if Larry has 40% of the business?
Yeah, Clay McGuirk has the smallest share, but probably the most important. I mean, he's getting paid the most. So he controls cloud infrastructure, all these data centers we're always hearing about. Mike Cecilia is apparently more of the operational guy, right? He is overseeing sales, support, and the like. A lot of what previous CEO Safra Katz did. Though importantly, from what former executive Safra Katz had, Larry Ellison now controls finance. And that's really important because Oracle's on the hook to spend kind of untold sums on its data center build out. And so, having that in Larry's steady hands makes sense.
What's so interesting is when you sort of break down ultimately what 40% is, and that's 64,000 workers. You've got to hope they're using generative AI to write up all their annual reports, Brody. But more broadly, are we seeing any let-off of Larry in control of this business?
No, and that's what's so interesting, right? I mean, the number of employees he oversees actually has increased, right? I mean, he can't live forever, none of us will, and so at some point we expect to see him start handing off responsibilities. But from anybody I've spoken with over there, it's not coming.
Bloomberg's Brody Ford on the need to know for Larry Ellison. Thank you very much. Disappointing some of our viewers learning that no one can live forever. That does it for this edition of Bloomberg Tech Carrot.
It's all about longevity investments, Ed. Don't forget to check out our podcast. You can find it on the terminal as well as online on Apple, Spotify, and iHeart. From New York, for San Francisco, this is Bloomberg Tech.